All right, today we're going to continue with our series Stock Market Trading for Beginners. We're on part 4 now. Took a little break there, and we had a lot of price action stuff we were talking about in the previous videos, and today we're going to add a little bit more to it because, as I said, the candlestick patterns and price bar patterns are only to be taken in the context of the entire landscape of the chart, the entire context of the chart. So we're going to add a little more context now. One of the most common techniques that's used in technical analysis is the use of moving averages. And there are many different kinds of moving averages, different lengths of moving averages you can use. And basically all these are, and this is a line right here that is a moving average, the red line that you see on the chart right now. And it's simply calculating the average of the closing price of the last, in this case, 50 bars. So I've got a 50-period simple moving average, and it just keeps, it's called a moving average because with every bar, it just creates a new plot point, and it creates a line. Now, why the 50-period simple moving average? Well, there's no magic moving average, by the way. Let's get that out of the way. The 50-period simple moving average is a good one to use, especially on longer-term charts like daily charts, weekly charts, and monthly charts. And the reason is very simple. It's simply because it is so commonly used by so many people. And for that reason, again, there's no magic to it. It's just that since a lot of people use it, there is a self-fulfilling prophecy to it. So, for example, if you look here, you can see what I'm talking about. And we're going to talk about two uses of it today. Number one is support resistance. So the market comes up here, and it bounces off the 50-period simple moving average. Okay, then when it does break through, it comes up here and it comes right back down to it. And whereas before it was resistance, now it's support, and it bounces off of it. Then it comes back down here, and we see it holding this entire time here until it finally breaks through. So that's the first use of it, and again, the only reason that happens is there's so many market participants watching that particular moving average that when prices come into that level, people will often buy or sell into it or take profits into it. The other most common using moving average for that is the 200-period simple moving average. So I encourage you to have both those moving averages on your charts, especially if you're using daily, weekly, or monthly charts. Okay, now another common use of the moving average is to determine trend. Now, let's be very careful when we talk about this. So often when I talk about indicators, people can be very critical of them. And in one way, that is correct. You should be very leery of indicators because a lot of times people present indicators to be more than they really are. In other words, they say, oh, this is the best indicator, that's the best indicator, this thing's amazing. None of them are amazing when it comes to making money. In fact, if they made us money, we'd call them money makers. So they're definitely not money makers. In fact, they are, I like the term indicator because that's what they are. They indicate, and that's all they do. So they are not meant to be used to make money in and of themselves, but they can be used as one tool in your toolbox in putting together an entire trading methodology for making money. So the 50-period simple moving average is a common tool used to measure trend. So we're going to use it to measure trend, and trend simply means the direction of the market. Actually, no, that's not correct. The dictionary definition of the word, Webster's dictionary at least, says that trend is the extended general direction of the market. Very important to understand those terms. Extended general direction. So what that means is you cannot use a short-term indicator to measure trend. A lot of times people are tempted to use shorter-term moving averages, for example, to measure trend because they say, well, it follows price more closely. You don't want that. That's exactly what you do not want when you're measuring trend because you'd actually be violating the definition of the word. Also, there's a financial benefit in using a longer-term indicator for trend, and that is that you get a better reward. So your risk-reward ratio is better if you're using an indicator that measures the long-term movement of the market. You get to stay in for longer periods of time. Again, can't be used by itself, but that is its piece of the puzzle in your trading methodology. So we use it as a line in the sand. So for example, the 50 MA here, pretty flat, but once it gets below the 50 MA, price gets below the 50 MA and stays below the 50 MA, we consider ourselves in a downtrend, in bearish territory. Above, we would consider ourselves in bullish territory. Notice how, again, it provides resistance here. Now, one last point for today's lesson, and that is with our candlestick patterns, or price patterns. So as you see here from the previous lessons, if you've watched the previous 3 videos in this series, this would be considered a bullish candlestick pattern because it has a rejection of value on the bottom below the 50 MA, and it's a wide range bar and it closes near the high. So, however, the problem is, and it engulfs the previous bar, at least the real body does. But the problem is this: the trend is not up, and it's just kind of actually flat here. So we've got to wait for the long-term indicator to give us some bigger picture direction in order for the candlesticks to show any real meaning. So therefore we wait and we see these are, again, very negligible. But this bar now, that becomes a very good signal bar, very bearish bar under the 50 MA, and the 50 MA is angling down. Same thing here. These are all very bullish bars, but they come right up into the resistance of the 50 MA, and the 50 MA is angling down. Therefore, I would wait and look at these 2 bars and see this nice reversal pattern here and say, okay, that is where I would actually take the candlesticks more seriously, because the 50 MA held as resistance, it's angling down, we're below it, and so candlesticks are short-term signals, and I want to take those short-term signals, but in the direction of the context of the longer-term indicator. So that's how we use them together. Now, in the next video, I will show you how to take that and take it even one step further. Remember, all of these are just each a little piece of the puzzle, another tool in our toolkit. So if you like this video, please click the like button below and leave a comment telling me what you'd like me to cover in future videos. If there's anything unclear here, feel free to tell me. Also, again, anything you'd like me to add to this series, I'd be happy to do it. I'm also giving away one of my courses called How to Trade Like the Pros, and you can get that course absolutely free. Just click on the image in the top left corner, or if you're on a mobile device, you won't be able to click on that. Instead, just click on the little eye with a circle around it in the top right hand of this video, and you'll be able to get access to the course that way, or in the description below, there's a link as well. So once you do that, I will personally email you the first video in the course. So hope you enjoyed the video. Leave your comments, and I'll get the next one out real soon.